are two important points about this trading setup. Everything we discuss in this video can be used for currency trading, stock trading, and crypto, because price action remains fairly consistent across different markets. Second, make sure to fully understand all of the steps we will explain for this trading setup before starting to backtest or trade it on the chart. Because this trading plan is a systematic method that takes into consideration multiple trading concepts for achieving the highest accuracy. Now let's get started. This trading plan consists of two major time frames. First, we have a higher time frame in which we will do most of our general analysis. We will read the market structure to find the direction, key levels, liquidity areas, and more importantly, fair value gaps, which are the optimal trading zones that might potentially provide us with a high-quality trading setup. In the second part, we will zoom into our lower time frame to find confirmation and enter the positions. Remember that this trading plan is not limited to any chart or time frames. However, your entry time frame must be 2 times lower than your higher time frame. Here are 3 time frame combinations that you can use to apply this trading strategy based on your trading style. For example, if your higher time frame is the 4-hour chart, you need to zoom in 15 minutes to execute the trade. Now we have simplified this trading plan into 2 major steps. So let's start with the first one. Analyzing the market structure in the higher time frame. In this general analysis, we implement the market structure concepts of smart money to the chart to simply find the market direction and key levels. To identify the market direction, we simply spot the break of structures, change of characters, and reversal liquidity sweep patterns on the chart. Now here on the candlestick chart, we have multiple breaks of structures to the upside, which shows that our direction is bullish. Then the market made a reversal liquidity sweep pattern above the previous high, which signals that a possible reversal is coming. This reversal later is confirmed if we get a break and close below this low. This is called a change of character, which shows that the buyers have failed to push the price higher, and the sellers are now in control. In the bullish scenario, the change of character happens when the price trades below the lowest point for 2 consecutive highs. Then the price is more likely to reverse, especially if it was in a long-term uptrend. Now, remember, if you can't clearly identify the market direction in a specific time frame, it is better to move on to the next pair. Because unclear market direction in a specific time frame increases the risk of making uninformed trading decisions. Moving on to the next pair allows traders to focus on opportunities where the trend is more apparent, promoting better decision-making and risk management. The second thing we look for in the higher time frame is the key levels. We identify the key levels for 2 primary reasons: identifying the liquidity areas and potential reversal points that are our higher time frame targets. When analyzing the chart, we consider the traditional support and resistance levels as liquidity areas, especially equal highs and lows or multiple rejections, which are considered critical liquidity zones. Now, why do we even need to identify liquidity areas on the chart? Liquidity is a key factor influencing price movements. The important thing to know is that the market tends to move towards the level that contains the liquidity. On the contrary, the market tends to move away from the level that recently has been liquidity swept. With all being said, grabbing the liquidity before reaching an optimal trading area is another confirmation for the price to make the movements we want to see in the market. These key areas might also reject the price a significant amount, so we would like to make sure that we have saved some profits before tapping into them. Also, always pay attention to how much space we have before reaching an important zone in front of the price, because we want to make sure that entering a trade with a reasonable risk-to-reward ratio. The last step in analyzing the market structure in the higher time frame is to identify fair value gaps, which are going to be our trading zones. But as we mentioned earlier, after identifying the FVG zones, we use the Fibonacci retracement levels to identify the location of the zone. If we are bullish, we are only interested in the fair value gaps that are located in the discount zone. And if we are bearish, we are interested in the fair value gaps that are located on the premium side of the range. Now, after identifying our optimal trading zone, we wait for the price to tap into that area and zoom into a lower time frame to look for reversal confirmations and execute long trades. This is the general idea. This is the checklist of concepts we apply on the higher time frame. Now, the second step of this trading plan is to look for confirmations and execute the trade in the lower time frame. After waiting for the price to enter our trading zone, we need to see some form of confirmation to show that this short-term downtrend is over and the price can push to the upside. To identify this reversal, we pay attention to liquidity sweep patterns and changes in character. A valid liquidity sweep below this low shows that a possible reversal is coming, and if the price breaks above this high, we have a valid change of character. After the reversal is confirmed, here is how we execute the trading setup. We wait for the price to create fair value gaps. That's why this strategy is called FVG and FVG. However, it does not mean that the lower time frame gap should be inside the higher time frame gap area. After spotting FVG areas in the lower time frame, we set our buy limit at the start of the FVG zone and put our stop below. For the first target, we make our trade break even by closing half our position when the price reaches our 1 to 2 target. The next target will be the first important zone in front of the price in the higher time frame. Now, before getting into some real chart examples, I want to explain some common scenarios that happen on the chart and how to handle them. In the first scenario, we have a very tiny area of fair value gap. When this scenario occurs, you need to consider a large zone as your stop loss, because we want our stop to be protected from the market fluctuations. In the contrary scenario, we have a large FVG zone in the lower time frame. Here the problem is that if we set our stop below this zone, we'll have a large stop loss. So we either can take a smaller zone below the FVG area as our stop, or we can set our buy order in the middle of the zone. This way, our risk to reward ratio will significantly improve if we end up winning. This is the checklist of concepts we apply on the lower time frame. Now let's see some examples on the real chart. Here on the Euro-Dollar 1-hour chart, we had a moving downtrend until we got a liquidity sweep pattern and a change of character. Both of them signal that the sellers are no longer in control and our direction is bullish. Now here we can identify two fair value gap areas, but only the one on the premium side of the range is considered as the potential trading area. Now in the next step, we simply wait for the price to enter our FVG area and zoom into a lower time frame to look for trading opportunities to go long. Here on the 5 minutes chart, we can see that the price has made a change of character by breaking above this line, which is our reversal signal. So we spot a new FVG area on the 5 minutes and put our buy order at the beginning of the zone and our stop below it. Our long-term target will be the next important zone in front of the price. Let's see what will happen. Here on the gold 1-hour chart, we have a moving downtrend. We have two areas of fair value gap, which could be a potential trading opportunity to go short. But if we apply the retracement tool, we can see that only this zone is valid for us. So, we wait for the price to return to this area and zoom into a lower time frame to execute the trade. Here, on the 5-minute chart, we have a change of character and a fair value gap area. So we will place a sell order at the beginning of the FVG zone and place our stop above it. Now let's see what will happen. Now, as you can see, we have a losing trade. This is the reality of the market. No matter how good your trading plan is, you will witness many losing trades. And it does not necessarily mean that there was something wrong with your analysis. But the key point here is that you should write down your rules and always follow them. Also, as long as you follow your risk management plan, you will absolutely be fine. Hey guys, the trading space is often filled with confusion and scattered information, making it hard to stick to a trading plan and achieve consistent income from the market. Therefore, we want to present a full smart money trading plan, guiding you step by step from beginning to end. In this video, first we will explain how to apply smart money concepts step by step on the chart to make a well-informed general analysis. Then, we will walk you through our trading setup, providing specific entry and exit points. Lastly, we will present the backtesting results, offering objective evidence of how the strategy has performed in the past. And let's get started. Now, a few key concepts in the smart money trading plan require practicing on the chart before grasping the trading strategy I'm about to share. First, we have market structure and direction. This involves determining the key levels of the chart's structure and identifying bullish, bearish, and directionless markets. Next, we have optimal trading zones and order blocks. These areas on the chart can potentially provide us with high probability trade opportunities. Moving on, we have liquidity concepts. Liquidity fuels all markets, and it's crucial to identify where positions could be liquidated to prevent unexpected losses. Lastly, we have entry setup and managing an open trade. Once certain favorable conditions line up and we find an entry point, we execute the trade with specific order details. Also, managing open trade requires monitoring market conditions and adjusting. Now let's get into the strategy. This trading plan consists of two major time frames. First, we have a higher time frame in which we will do most of our general analysis. We will read the market structure to find the direction, key levels, fair value gaps, liquidity areas, and more importantly, optimal trading zones that might potentially provide us with a high-quality trading setup. In the second part, we will zoom into our lower time frame to find confirmation and enter the positions. Remember that this trading plan is not limited to any chart or time frames. However, your entry time frame must be 2 time frames lower than your general higher time frame. In this video, we are only going to use 2 time frame combinations. If we analyze the market structure and find optimal trading zones in 4 hours, we will look for confirmations and entries in 15 minutes. Similarly, if our higher time frame is the 1-hour chart, we will zoom into 5 minutes to open positions. Now I have simplified this trading plan into 5 simple steps. After we go through the steps, we will look at the entry models to explain how the strategy could be implemented visually. If you cannot completely understand each of these steps, be patient because we're going to explore them in depth with multiple real chart examples. At the end of the video, I will show you the backtesting results, which will provide real evidence of how well the strategy has performed in the past. So let's start with the first step, analyzing the market structure. In this general analysis, we implement the market structure concepts of smart money to the chart to simply find the market direction and key levels. We have 3 types of markets in terms of direction. We have a moving uptrend, where the price continuously makes higher highs and higher lows, breaking the structure to the upside. So we want to trade with a dominant uptrend because it increases the chance of success. This process continues until we get a change of character, which signals a possible reversal. Change of character occurs when we get a break and close below the lowest point of swing low between 2 consecutive highs. Second, we have a moving downtrend where the price continuously makes lower lows and lower highs, breaking the structure to the downside. Once again, we want to trade with the dominant downtrend until we get a change of character. Then the market sentiment will change to bullish. We also have a directionless market, which occurs when the supply and demand are not powerful enough to push prices into a directional trend. When we continuously get changes of characters on the opposite side and can't surely identify the trend, we have a directionless market. This trading plan is a trend continuation strategy, so implement it when you can clearly identify the price direction. Here we have pound yen on the 4 hours chart. Let's implement the first step to find the direction and key levels. Here we have a clear moving uptrend that made a series of higher highs and higher lows and breaks to the upside. The market sentiment is bullish, and we only want to look for buying opportunities. These are 2 of the recent consecutive highs, so the lowest point of this correction is our swing low. And as long as we stay above this key level, we identify this market as bullish. The second key level is our latest high created by the price, which we will use to set our higher time frame target level. Now let's continue and see what the market will do next. Here we can see that the market broke structure and created a new high, but the market barely pushed the price upwards, and look at all our rejections, which shows a significant momentum loss. Then we have a break and close below the latest swing low, which makes it a valid change of character. Now we are no longer in an uptrend, and all we need to do is wait for a 1, 2, and 3 moves to the downside to identify the direction as bearish. Then, we mark the most recent key levels and look for short opportunities. Now this is all we need in the first step, identifying the market direction and key levels. Let's continue with the second step, key concepts of smart money. This step will identify fair value gaps, liquidity areas, and optimal trading zones on the higher time frame chart. The fair value gap is a 3-candlestick pattern characterized by a significant gap between the shadows of the first and last candles, with no overlap. These gaps are created when we have an imbalance between the buyers and sellers, resulting in sharp moves. The market often returns to these gaps to take the remaining orders and restore the balance. Then, if we have enough liquidity, market will seek to continue in the same dominant direction. Liquidity is the fuel of the market. Liquidity areas are where retail traders enter the market and place their stops. Let's focus on equal highs and lows and the latest swings for simplicity. If the market grabs the liquidity areas, the chances of success will significantly improve. Optimal trading zones refer to areas where high-quality trading concepts conflict. Valid order block and order flow areas that meet the rules will be great levels to look for trading opportunities. Now, let's apply the second step to the real chart examples. Here on the Euro-Dollar 4 hours chart, we have a moving downtrend. These are the considerable fair value gaps that are recently created. If the price returns to fill the gaps before continuing its general direction, it will provide us with a perfect trading opportunity. Now, where's the liquidity area? We know for a fact that this level was our previous swing low. So if the price returns to this level, support turns resistance, and we expect a form of rejection. Traditional price action traders will see this as a short opportunity and sell the market. They will place their stop above the zone, which makes a lot of liquidity gather above this zone. So there is an opportunity for the big players to grab the liquidity they want, and the price will fall after the stops are triggered. This is why you have to identify the liquidity or become the liquidity. Now, where is our optimal trading area? The candle that created the bearish inefficiency or the latest bullish pressure before the drastic move to the downside is a great place to look for short trading opportunities. But no matter how good your entry zone is, the market can easily ignore it and continue with the dominant momentum. That's why we need double confirmation and witness reversal signals on the lower time frames. Here on the dollar-yen 1 hour's time frame, we have a moving downtrend. Let's apply the second step and mark the fair value gaps, liquidity areas, and optimal trading zones. We have a considerable fair value gap here, so we point it out. The market has created strong resistance and rejected this level multiple times, so we have a lot of liquidity gathered above these equal highs. This order block is a great area to look for short opportunities since it has a lot of great confluence. These are all the concepts we apply to the chart in the second step. In the next step, we wait for the price to come and mitigate the fair value gaps. Then we will zoom into the lower time frames to look for confirmations and enter short positions. Now let's continue with the third step, the confirmations and entry. In this step, we will apply the market structure concepts, wait for entry signals, and open the position aligned with the higher time frame analysis. After mitigating the fair value gaps area, we will look for reversal signals to confirm the entry. We must wait for a change of character to verify that the short-term trend is over and the market can continue going with the dominant higher time frame direction. If we have no change of character, we will have no trade. After the change of character confirmation, we have two entry trading models. In the bullish scenario, if the change of character move creates a valid order block with fair value gaps, we will place a buy limit a spread size above the order block and stop below the swing low. We will make our trade break even by closing half our position when the price reaches our 1 to 2 target. Next, we will close our profits if the price reaches our higher time frame supply area. The second trading setup occurs with no fair value gap and order block. In this case, we will put the Fibonacci retracement tool from the start to the end of the change of character move and place our buy limit precisely at the middle of the 618 and 786 levels. Our stop will be below the swing low and apply the same concepts for taking profits. Now let's have a quick recap of all of the steps we discussed. In this trading plan, we use 2 time frames. We have a higher time frame in which we do most of our general analysis and assess market conditions. Then we will zoom into the lower time frame to find confirmation and enter the trade. This trading plan is not limited to any time frame, but your entry time frame must be at least 2 times lower. In the first step, We analyze the market structure to find the market direction and key levels. We will point out breaks of structures and character changes to identify the market direction and mark the key levels that price can react to. For example, here we have a moving uptrend with multiple consecutive breaks to the upside. Since the direction is bullish and we want to trade with the dominant trend, we are only interested in long opportunities. This is the latest high created by the price, which we expect a possible reaction, making it a suitable place to set our long-term target. This level is our recent higher low, which is also a key level, and if we get a break and close to the downside, we will no longer consider this market an uptrend. In the second step, we apply the key concepts of smart money on the chart and identify fair value gaps, liquidity areas, and optimal trading opportunities. So here, if the price makes a deep correction mitigating the fair value gap area and grabbing the liquidity under these equal lows, we will have a perfect trading opportunity to go long. Now, when should we buy this pair? We know this move is a short-term downtrend in the lower time frames, so we will zoom into the lower time frame to look for reversal and trade entry. In the third step, we will wait for a change of character to confirm that the short-term downtrend is over and the market can continue pushing upward. We will use two entry setups to open positions. Number 1, if the change of character creates fair value gaps, we will place our buy limit a spread size above the order block. Number 2, if we have no gaps, we will use the retracement levels and enter positions in the middle of the 618 and 786 levels. Stops will be below the swing low and we can use multiple trade management strategies. Here's the checklist and important information about this trading plan we will use. You can risk 2 to 3% of your capital per trade and only have up to 3 open trades. But remember, before using this strategy with real money, you should backtest it on the past data to obtain the performance. Backtesting allows you to build the required confidence and prepare for potential risks associated with the trading. But unfortunately, it can be very time-consuming. That's why we use Trader Edge to backtest and keep track of all our trades. Let's suppose we want to backtest a trading setup on the euro-dollar in 1-hour time frame. We will first set up the chart on TradingView and adjust it. Then we will open Trader Edge's backtester and arrange it next to the chart. Here we will input our starting balance and risk per trade, which we've set to 2%. You can change this to any value you prefer, whether in dollars or percentages, for each individual trade. Once we're done with the backtesting, Trader Edge will provide us with a detailed matrix, including important information such as win rate, maximum drawdown, and profit results. It also allows us to save the data and add more backtests, which will all be stored. Now, when we began backtesting, we randomly selected a period for the euro-dollar pair. Surprisingly, the first setups yielded a significant amount of profit. So let's walk through the chart step by step to illustrate what was going through our minds during the backtesting process. Here we have euro-dollar on the 4-hour time frame. The market has recently broken below the structure level, signaling a downtrend continuation. So we want to trade with the dominant downtrend. Here we have fair value gaps between the candles and this resistance level, which traditional traders will take as a short opportunity. So lots of liquidity have gathered above it. An optimal trading opportunity would be to wait for the price to mitigate the gap area, grab the liquidity, and look for reversal confirmations on the lower time frames to enter short positions. So we zoom into 15 minutes time frame and wait for the price to make a change of character to confirm the short entry. But as you can see, we have no change of character due to massive bullish pressure, so we won't have any short trades. So let's get back to the 4-hour chart. Here we can see that the price has broken above the recent lower high, indicating that the previous downtrend is no longer valid. Now, regarding market structure, we have a double bottom reversal pattern, with the second leg as a liquidity sweep movement. This strongly confirms that the market sentiment has changed to bullish. Now, we can identify a significant fair value gap on the chart, presenting a potential long trading opportunity. We will patiently wait for the price to return to this gap area, and then zoom into the 15-minute chart to enter long positions. On the 15-minute chart, we can see that the market has made a change of character, signaling that the short-term downtrend is over and the price can continue pushing upwards. This movement has created fair value gaps, so we'll use the first trading model. We'll place a buy order a bit above the order block and set a stop below the recent low. Now, the market has given us another trading opportunity without triggering the first trade. There's a fair value gap and another order block, so we'll place another buy order without canceling the first one. We're still determining what the market will do next, but we will always stick to solid entry rules. In the best case, it will trigger one of the orders and continue pushing up. Or it could reverse and cause us to lose both of the trades. Let's wait and see what happens. The price triggered our second trade and hit our target, resulting in a 4% gain. This is because we risked 2% of our capital per trade. Now, we have another order block and a new trading opportunity. So, without canceling the first trade, we'll open another position. Our first target will be twice our risk, and let's track our profits if the price moves in our favor. The close of these candles can be a reliable place to set our higher time frame target, and we will track our profits until we reach here. Let's see what the market does. The market has hit our first target, making us break even. This means that even if the price retraces and triggers our stop, we won't lose any money on the second trade. Every time the market makes a new higher low, we adjust our stop a couple of pips below it to secure our profits. Now, this trade turned out to be great and gave us massive profits. But remember, trading live will be much more difficult because you also have to deal with emotions. However, backtesting on past data is the best way to test the trading system and prepare for different trading scenarios. Now, these are the results we have got after backtesting this trading plan on the euro-dollar pair for a month. We had taken 16 trades during this period. Although our win rate was 50%, we gained 23% profits. Our profit factor was 2.38, and we only suffered a 4.75% drawdown. But remember, trading on the live account involves real money and real emotions. It's a whole different ballgame compared to paper trading or simulations. The key to success is sticking to your trading plan, which acts as your blueprint for success. So guys, in today's episode, we're taking a deep dive into the smart money concept's various entry and exit setups, and uncovering the pros and cons of each when it comes to executing trades in the Forex market. We won't just stop at that. We're here to show you precisely how and where to enter and exit a trade with an optimized entry that could revolutionize the way you approach the market. We'll walk you through the essential rules and criteria for identifying high-probability trades and learn about the factors that could turn a perfect setup into a losing trade. Plus, we'll navigate the intricate dance of price behavior across different trading sessions. Giving you the edge, you need to make smarter trading decisions and increase your odds of success. Setting an optimized entry in trading is crucial because it directly impacts your risk-to-reward ratio and the overall success of your trades. An optimized entry increases the potential profit you can make if the trade goes in your favor. It helps you place your stop-loss orders closer to your entry point, reducing potential losses if the trade goes against you. By fine-tuning your entry, you can control your position size more effectively and manage your overall risk exposure. An optimized entry increases the probability of the trade moving in your favor, improving your win rate over time. It encourages disciplined trading by following a well-defined plan, which is essential for long-term success. Imagine we have a perfect sell setup here that meets the criteria and rules of a high-probability setup. These are the criteria we always look for in the market to identify such a setup. Firstly, you can see that the price is in a strong downtrend and has already reversed from a strong supply zone on a higher time frame. The next criterion is that the price must fill the fair value gaps. Yes, the price has done that. It swept the internal liquidity by filling the fair value gaps created during the downward movement, and now it's ready to move toward external liquidity. The next rule is that the buy-side or sell-side liquidity must be swept. And yes, we can see it on the chart. Price swept the liquidity above the previous structure here and immediately pushed back down, closing below the highs range. This allows us to identify a liquidity sweep pattern and a newly formed supply zone. This presents a good opportunity to go short if we decide to place an entry. The key idea behind this rule is that when buy-side liquidity is cleared out through a liquidity sweep, the price is then attracted to the sell-side liquidity, which is in line with its prevailing direction. Our fourth rule is that the price must be situated in the premium zone to consider placing a short position, or it must be in the discount zone to consider a long position. It's pretty clear that here, the price is above the 50% of Fibonacci retracement. The last rule is the presence of a higher time frame liquidity zone in front of the price that can be utilized as a potential take-profit level. When all these rules and criteria align, we have a high probability trading setup. However, the biggest challenge traders face after identifying this perfect setup is knowing how and where to enter the trade. This is the most critical and tricky part of trading. If you can't set up an entry optimally, you might still experience losses, even if you've identified a flawless trading setup and predicted the price's future direction. There are three main entry setups. The first one is the aggressive entry model, which carries more risk. The second is the conservative entry model, which offers entries with additional confirmation. And the third is the ultra-conservative model, which provides a setup with multiple confirmations across various time frames. Now let's get started with the aggressive entry model. Executing a trade using this entry model is like to placing a limit order within the higher time frame's demand or supply zone. Imagine we have a perfect sell setup, like the example on the chart, confirmed by the criteria and rules of a high probability trading setup. For placing a short position using this entry model, your entry point should be right at the lowest point of the supply zone. To manage risk effectively, set your stop loss a few pips above the highest point of the zone. When it comes to take profit, you can target the closest external liquidity at the same time frame, as we anticipate that price will move in that direction. Alternatively, you can aim for the higher time frame's major liquidity zone to achieve a higher reward to risk ratio. Risky entries come with their advantages. You're less likely to miss trading opportunities, and you don't have to constantly monitor the charts. However, there are drawbacks to consider. It provides higher risk because you've entered into the market without a reversal confirmation, and also you are not watching the price reaction when it reaches the area of interest. For instance, consider a situation where it coincides with the London-New York crossover, and a news event caused volatile price movement. There's a high chance the price hits your stop loss, and then starts moving down. Since this entry method involves a larger stop loss area, it obviously provides a lower reward to risk ratio. Now let's move into the conservative entry model details. In this entry model, we employ two different time frames for our trading approach: a higher time frame for market analysis and a lower time frame for entry confirmation and order execution. I personally prefer using the 15-minute time frame for market analysis and then switching to the 1-minute time frame for executing my trades. However, you have the flexibility to choose other time frame combinations, like the 1 hour and 5-minute or the 4 hour and 15-minute, depending on your preference. The key principle to remember is that your market analysis time frame should be at least twice as long as your entry time frame. To apply the conservative entry, we should wait for price to tap into the point of interest zone and show a rejection. Then our next step is to switch to a lower time frame. Closely monitor the price movement and patiently await the formation of a valid change of character pattern. After detecting the confirmation of market structure shift on the entry time frame, we can set our entry position on the lowest point of the newly recognized order block, in this case, a supply zone on the lower time frame, which is created by the change of characters wave. With a stop loss set a few pips above the highest point of the zone. And for the take profit, we set it at the external liquidity of the higher time frame. The pros of this entry setup are that it ensures a reaction at the point of interest by closely monitoring lower time frame price action, resulting in a higher reward to risk ratio due to the use of a tighter stop loss on the lower time frame. However, there are cons to consider. If the price decides to flip the identified point of interest and continues its upward movement, your stop loss placed on the lower time frame may get hit. Because by using this type of entry, there's also the possibility of a continuation flip pattern forming on the higher time frame. Or if the price requires more buy-side liquidity to be swept, using this type of entry may trap you in the market. Another drawback is that you're more likely to miss out on trades if you refine your entry zone too much. Now let's dive into the third entry setup, the ultra-conservative entry. Imagine we have a perfect sell setup on a higher time frame like the 4-hour time frame, which is confirmed by the criteria and rules of a high probability trading setup. Our next step is to switch to a lower time frame, like the 1-hour time frame. Closely monitor the price movement and patiently wait for the price to return to the higher time frame supply zone and demonstrate a change of character pattern. After detecting the confirmation for market structure shift on the 1-hour time frame, to apply the ultra-conservative entry setup, we need to follow a few steps. First, we should identify and highlight the supply zone generated by the change of character's bearish wave. Then we need to zoom into a lower time frame like the 15-minute time frame and patiently wait for the price to tap into the identified 1-hour time frame supply zone to get reversed from it and create a change of character on the 15-minute time frame. Our next course of action is to identify the order block generated by Chalk's wave in the 15-minute time frame. In the next step, we should zoom into the 1-minute time frame and wait for the price to enter into the 15-minute time frame supply zone to get reversed from it and show a change of character pattern. Once the change of character is confirmed in the 1-minute time frame, we can proceed to identify the order block attributed to the change of the character's wave. Subsequently, we place a sell limit order at the lowest point of the zone, with a stop loss set a few pips above the highest point of the zone. As for the take profit, we have the option to target the unmitigated demand zone on the higher time frame like 15 minutes or 1 hour, or the swing low of the current time frame. These steps will help us execute an ultra-conservative entry with a well-defined risk-reward ratio. The ultra-conservative entry model has its advantages. It utilizes multiple time frame reversal patterns for trade confirmation, significantly boosting the likelihood of successful trades. Moreover, it offers a more favorable reward-to-risk ratio by meticulously refining entry points on lower time frames. However, there are notable cons to consider. First, this approach demands more time for monitoring price movements across various timeframes. Additionally, seeking extensive confirmation before executing trades might lead to missed opportunities, even if prices move in the anticipated direction. Another downside is the potential to miss many trades when overly refining the entry criteria. Now that we have fully covered all the entry setup options available for placing buy-or-sell positions in the market and have acquired a solid understanding of them, imagine we've identified a high-probability trading setup on the chart that aligns perfectly with the criteria and rules of a high-probability setup. What we're doing next is searching for an entry point and, most importantly, getting involved in the market. Before executing any trade, it's crucial to consider a key factor: invalidation. We need to be mindful of the elements and conditions that could invalidate our trading setups, potentially resulting in a losing trade. This applies to all our trading setups, even those that appear perfect and highly probable. If we identify any factors leading to invalidation, if we identify any signs of invalidation, it's a clear signal not to enter the market. So what factors can cause the invalidation of a trade? The first and perhaps most critical factor to consider is the time of day. Imagine you've identified a flawless and perfect trading setup, one that aligns perfectly with your trading plan, offering an exceptionally high probability of success. The price is on the brink of reaching your highlighted point of interest, and you've set an appropriately small stop loss, creating an ideal trade opportunity. However, there's a catch. The market lacks the required momentum and liquidity. This might happen during the Asian session or in the late hours, like around 12 p.m. or 5 a.m. In such cases, the likelihood of this trade becoming a winner is rather low. To trade successfully at the right times, you need to know how the market acts during different parts of the day. Each part has its own behaviors, like how things move in Asia, or when London has reversals or fake-outs. Also, it's important to understand when these trading times overlap, such as when New York and London are both active, and what usually happens during those times. This knowledge helps you make smarter trading choices and boosts your chances of winning trades. Before we delve into the next factor that can invalidate a trade, let's take a moment to explore these trading sessions and their behaviors. The Forex market operates 24 hours a day, 5 days a week, and is divided into different trading sessions based on major financial centers around the world. Each trading session has unique characteristics, and price behavior can vary during these sessions. There are 4 main trading sessions. The first is the Sydney session, which runs from 10 p.m. to 7 a.m. in the GMT time zone. This session mainly involves 3 currency pairs: the Australian dollar, New Zealand dollar, and Japanese yen. Next is the Tokyo session, which also runs from 10 p.m. to 7 a.m. in the GMT time zone. The primary currency involved in this session is the Japanese yen. Additionally, there is some overlap with the Australian dollar and New Zealand dollar pairs. Tokyo session is known for its stability and liquidity, especially in JPY pairs. Volatility can increase during economic data releases from Japan. The third major session is the London session, which runs from 8 a.m. to 5 p.m. in the GMT time zone. London is the financial hub of the world, and this session sees the highest trading volume and liquidity. It often sets the direction for the day. Price swings and trends are more pronounced. The fourth major session is the New York session, which operates from 1 p.m. to 10 p.m. in the GMT time zone. The New York session also has significant liquidity and is known for high volatility, especially during the overlap with the London session. Economic data releases from the US can lead to significant price movements. Also, we have overlapping sessions. There are times during the trading day when multiple sessions overlap, such as the London-New York overlap, which occurs from 13 o'clock to 17 o'clock GMT. These overlaps often see the highest trading activity and are characterized by increased volatility. Now, let's have a quick breakdown of prices' behavior during major sessions. Asian sessions. Typically, prices may consolidate or trade within a narrower range during the Asian sessions as liquidity is lower. Breakout moves often occur when the London session begins. London session. This is when the market tends to see the most significant price movements and trend formations. Many traders prefer to trade during this session due to its high liquidity and volatility. New York session. Similar to the London session, the New York session can also see substantial price swings, especially during economic data releases and news events related to the US economy. It's important to note that while these sessions have their typical price behaviors, unexpected events and news can lead to sudden and significant price movements at any time. Traders should be aware of these sessions and their characteristics when planning their trading strategies and risk management. Now let's delve deeper into the details of invalidation. As previously mentioned, the first factor that can lead to invalidation is the timing of our trade execution. If a setup occurs outside of the optimal trading hours, we will choose to refrain from trading. For the London session, the most optimal time for trading is generally during the first few hours. This period often sees the highest liquidity and the most significant price movements. Many traders prefer to start trading when the London session opens at 8 o'clock GMT, because this is when markets tend to set the initial direction for the day. Major economic data releases related to the European economy are often scheduled during this session, which can lead to increased volatility. The most optimal time for trading during the New York session is typically during the overlap with the London session. This overlap often experiences the highest trading activity and liquidity. The first few hours of the New York session can also be favorable for trading, as this is when US economic data is released and can result in significant price movements. It's important to note that after 17 o'clock GMT, liquidity can start to decline as the New York session winds down. Personally, I prefer to not trade after 5 p.m. because, particularly after that, most likely price will consolidate around major zone that has been formed through the day until London session starts at tomorrow. And for the Tokyo session, the most optimal trading time during this session is generally during the overlap with the London session, as both sessions see higher liquidity and potential for price trends. The next factor to consider is news and economic events. Forex markets often experience increased volatility and price fluctuations around the time of major economic releases. Economic news and events are critical drivers of price movements in the Forex market. Traders need to stay informed, develop strategies that suit their risk tolerance, and exercise caution when trading around news releases. If there is a very high-impact news or economic event either already released or scheduled to be released around the time your point of interest is being approached, it becomes risky to enter the market. This is due to the significant increase in liquidity and volatility such an event can create. Let's see some important economic news releases that can significantly impact the Forex market. First, we have the non-farm payrolls, NFP, published by the U.S. Bureau of Labor Statistics on the first Friday of each month. Measures changes in the number of employed people in the U.S. The second one is interest rate decisions, announcements by central banks regarding changes in benchmark interest rates. Changes in interest rates can influence currency values as they affect capital flows and borrowing costs. Number 3 is gross domestic product, GDP, measures the total economic output of a country. GDP releases can indicate a country's economic health and influence its currency value. And the next economic event is the Consumer Price Index, CPI. Measures changes in the prices of a basket of goods and services. What I highly recommend during a news event is to wait patiently for the excitement and volatility created by the event to settle down. Then, assess the situation and look for potential entry points. Avoid using pending orders like sell or buy limit orders during a news event. The third factor that can lead to invalidation is a sudden and rapid push into a point of interest. Price behavior is crucial, especially when it approaches our identified point of interest. Imagine the price suddenly gains strong buying momentum and moves directly into your identified bearish point of interest, from which you plan to enter a short trade. In such a situation, you should reconsider that zone as your point of interest and avoid executing trades from there. The rapid and massive move toward that area could keep pushing the price upward as it sweeps up buy-side liquidity, increasing its speed and volatility. This increases the likelihood that the price will use your identified point of interest as another source of liquidity. The next and last factor that can lead to invalidation is the fundamental. Traders should consider fundamentals alongside technical analysis in their training because fundamentals provide essential context for understanding market forces, identifying long-term trends, and managing risk. Ignoring fundamentals and relying solely on technical analysis can lead to missed long-term opportunities, increased vulnerability to news events, inefficient trading, and difficulties in adapting to changing market conditions, potentially resulting in significant losses. Accurately identifying and mapping the market structure, along with its crucial elements, is the initial key step that every trader must take on their trading journey for success and profitability. One of the primary reasons many traders face losses is their failure to properly identify and understand the market structure. In this episode, we explain both advanced and basic concepts of market structure that are essential for every trader to understand and apply in their trading journey. Additionally, we will unveil the keys and tips for market structure mapping, propelling you one step ahead in the market. Be sure to watch the entire video slowly until the end, and take notes for a better and more comprehensive understanding. So let's get started with the market structure general behavior. The dynamics behind market movements can be boiled down to two key factors that consistently influence price direction: trending, which includes uptrend and downtrend, and the second factor is the consolidation phase, like a choppy or ranging market. Imagine it like a continuous circle, where price always moves between downtrends, uptrends, and also consolidations that accumulate liquidity and institutional orders. Price usually needs to consolidate between uptrends and downtrends and vice versa. The first question to consider when opening charts on your screen is whether the market is in an uptrend, downtrend, or consolidating phase. To gain a solid understanding, let's begin with a basic introduction to market structures and then delve into the key points of advanced market structures. Consider a market structure that represents an ideal uptrend. I refer to this type of market structure as ideal because it is rare to find an uptrend in the market that exactly mirrors this pattern. Prices typically do not behave with such simplicity. Nonetheless, for a clearer understanding of an uptrend, let's briefly take a look at this ideal structure before moving on to a more realistic uptrend structure that frequently emerges in the market. In an uptrend, prices consistently form higher highs and higher lows. The price typically breaks the previous highs while holding the lows. An uptrend ends when the price breaks one of the major lows to the downside. For example, to maintain the uptrend, it's crucial that price does not break this major low. Whenever the price breaks a major high to the upside, it forms a break of structure and establishes a demand zone associated with the BOS wave. Identifying valid major highs and lows is critical as it enables us to detect signals for a trend reversal or continuation in the market. Without proper identification of these pivotal points, there is a risk of falling into traps and trading on the wrong side of the market. The same concepts apply to the bearish scenario. In a downtrend, prices consistently create a series of lower lows and lower highs. In this scenario, the price has a tendency to break the previous lows while maintaining the highs. Now, let's delve into the details of the realistic market structure. This represents the realistic uptrend structure that is more commonly observed in the market. Now let's consider a scenario where the price breaks the previous highs to the upside. At this point, a crucial question arises. How do we identify valid major highs and lows? To address this, if we look at the left side of the structure, it is clear that price experienced an upward movement until it started to retrace. The highest point reached by the price before the retracement movement began is considered the major high. Additionally, the lowest point of the bullish wave that initiated the upward movement, leading to the formation of a break of structure and a new high, is recognized as the major low. These 2 points constitute the major external structures, and every structure formed between them is regarded as an internal structure. If the price breaks the major high to the upside, creating a break of structure, BOS, it signals a continuation of the trend. However, if the price falls below the major low, we should consider it as a trend reversal signal. The specific internal price action within the range of external structures doesn't matter, as long as the price remains above the most recent major low. As long as this condition is met, we consider the market to be in a bullish state. Now that we've identified the recent major external structures, these structures define the current area of interest and the current trading range. As we see, the price has entered the retracement phase, generating a series of internal structures, particularly bearish ones. Subsequently, after forming a bullish internal realignment, the price breaks the recent major high to the upside, establishing a fresh major high and low. The newly generated major low is this internal low situated at the extreme. This low is considered major because it is the last low created before the price initiated an upward movement leading to the break of structure. You might be wondering why we don't regard this low structure as the major low. The rationale behind this is that the low located at the extreme is the ultimate and lowest point before the price initiates an upward movement. This particular low is crucial as it is the key low that triggered the upward movement and subsequently the break of structure. Moving on to the bearish scenario, which is simply just the same as the bullish scenario, let's consider a bearish break of structure, with a major high initiating the bearish wave leading to a break of structure. Additionally, we have a major low, marking the lowest point the price reached after the break of structure. These 2 structures, the major high and low, constitute our external structures, while everything formed between them is considered internal structures. If the price breaks the major lows to the downside, creating a break of structure, it signals a continuation trend like what we see here. However, if the price rises above the major high, we should consider it as a trend reversal signal. In simpler terms, the nature of internal price action within the external structures doesn't matter, as long as the price remains below the most recent major high, indicating a bearish market. As the price retraced upward, it formed a series of internal highs and lows within our trading range. However, it eventually went back down and broke the recent major low to the downside. This internal high located at the extreme becomes our newly generated major high. This is because it represents the highest internal high created before the price initiated a strong bearish push, resulting in a new break of structure. Following this, the price retraced once more, forming another major low. Subsequently, after creating various internal structures, the price continued its downward momentum, establishing a sequence of lower lows and lower highs. Now, we will delve into another crucial aspect of market structure, the break of structure, BOS. You've likely encountered BOS in various trading tutorials, market structure videos, and trading handbooks. For example, in a bullish structure is often defined simply as a situation where the price breaks a high to the upside. However, in reality, there are specific rules and key points that we must consider to identify a valid break of structure. Now let's move on to the specifics of those key points and rules. A valid break of structure occurs when the price breaks and closes above the most recent higher high with the body of a candle. This holds true even if the price immediately moves downward after breaking the structure. In this scenario, the price generates a new major low and major high and establishes a new trading range. If the price subsequently breaks this newly regenerated major low to the downside, it indicates a potential trend reversal. This shift signals that the price is no longer bullish, marking a change of character. However, If price breaks the recent higher high with a long shadow or wick, and the body of the candle promptly closes below the range of the high, with the subsequent candle's wick not surpassing the first candle's wick, we do not consider this scenario a valid break of structure. In this case, we regard this low as an internal structure formed inside our trading range. To identify a trend reversal signal or a valid change of character, we should wait for the price to break the major low located at the extreme rather than breaking the upper internal high. Now, consider another scenario. If the price breaks the recent higher high with a wick, and then the body of the first candle closes below the range of the high, with the subsequent candle's wick exceeding the first candle's wick, we can consider it a valid bullish break of structure. In this case, we have a newly formed major high and a major low defining our updated trading range. The nature of internal price action within the range of this high and low doesn't matter, as long as the price remains above our newly generated major low, indicating a bullish market. Only if the price breaks the newly formed low to the downside, we can consider it a valid trend reversal signal or a valid change of character pattern. Now let's briefly break down the bearish scenario, which is essentially the same as the bullish one. Consider a bearish market structure. To have a valid break of structure, we require the price to break and close below the most recent lower low with the body of a candle. Therefore, if the price breaks the newly generated major high to the upside, we consider it as a trend reversal signal, indicating that sellers have lost control. Conversely, if the price breaks the recent lower low with a long shadow or a wick, and the body of the candle promptly closes above its range, with the subsequent candle's shadow not surpassing the first candle's wick, we should not regard it as a valid break of structure. To establish a genuine bearish break of structure, we should wait for the price to close below the low's range with the body of a candle. On the other hand, if the subsequent candle's wick exceeds the first candle's wick and closes above the low's range, then we have a valid break of structure. Additionally, we need to update our major low and major high. As long as the price remains below our newly generated major high, we consider the market's direction as bearish. Only if the price breaks the newly formed high to the upside, we are allowed to consider it a valid trend reversal signal or a major change of character. Having explored various types and scenarios of break of structure patterns, and now possessing a solid understanding of a valid BOS, let's delve into another key factor of market structure mapping: change of character. To identify a valid change of character, the first step involves determining the general market direction, whether it's in an uptrend or downtrend. Subsequently, you must highlight the valid break of structures on your price chart. In the bullish scenario, imagine the price creating a series of valid break of structures. This low and high represent our major structures associated with the first valid bullish BOS. As previously mentioned, any price action forming between these two structures is considered internal. Change of character patterns can be categorized into two types: minor and major. For example, each time the price breaks any internal low, it signifies a minor change of character. It's important to note that a minor change of character alone cannot be regarded as a sign of a shift in the market structure. Here, we're facing a common scenario that frequently occurs in the market. Many novice traders, who haven't correctly identified the market structure, often consider this minor change of character a signal of a reversal in market direction. They believe that the bullish phase has ended, and it's an ideal time to go short. They typically place their stop loss just above this internal high. However, contrary to their expectations, price, after making a brief retracement, went back up and continued its bullish movement. This resulted in hitting the stop loss of traders who had taken short positions. They often fail to realize why their stop loss was triggered by the price, and unfortunately, they repeat these actions repeatedly. What they missed here is a crucial point. The price didn't break this major low over here to confirm a market structure shift. They shouldn't have entered a short position until the price broke the last major low to the downside. Their identified change of character was invalid, and the price only was in its retracement phase before continuing to its primary direction. To obtain a valid market structure shift signal, one should patiently wait for the price to establish a major change of character by breaking and closing below the last major low that initiated the upward movement, leading to the bullish break of structure. Furthermore, it's crucial to always remember that in a bullish scenario, a change of character pattern is considered valid only when the price breaks and closes below the last major low with the body of a candle. If the price breaks the most recent structure with a long wick or shadow and closes within the highs range, then the change of character is invalid, and we cannot consider it a market structure shift. The same concept applies to the bearish scenario. For a valid change of character that provides a high probability, we need the price to break and close above the recent major high with the body of a candle. A penetration with a shadow or wick is not acceptable.